All right, let's get straight to it. We are looking at Ethzilla Corporation, ticker ETHZ. As of this moment, the stock is trading at $16.80 per share. Now, if you just pull up a standard chart on your phone, you are seeing something absolutely wild, a gain of $15.13, which translates to a surge of over 900% today. It looks like one of the most explosive moves on the entire market, the kind of move that makes people instantly rich and has chat rooms and social media completely melting down. The immediate expectation, the gut reaction, is that this tiny company must have cured a disease, gotten a $10 billion government contract, or announced that Peter Thiel, who is already a known backer, decided to buy the entire rest of the company outright. That's the expectation. But here is the immediate, critical reality that you absolutely must understand before you even think about placing a trade on your Robinhood app or SoFi Invest platform. This is not what it appears to be. This is not a fundamental, value-driven 900% rally. What you are seeing is the technical, mechanical, and pre-announced execution of a 1-for-10 reverse stock split, which went into effect this morning, October 20th. So, let's break down what that really means. If you went to bed on Friday owning 1,000 shares of ETHZ, which closed at about $1.67, you woke up this morning only 100 shares. To keep your total investment value the same, the exchange automatically multiplies that $1.67 price by 10, giving you a new starting or adjusted price of $16.70. This current price of $16.80 means the stock is actually up about 10 cents from its new adjusted price, a gain of less than 1%. The 900% spike you see is a charting artifact. It's the ghost in the machine, the line on a graph trying to connect Friday's $1.67 reality with today's $16.80 reality, without understanding the 1-for-10 consolidation that happened in between. So no, you did not hit the lottery. What you are witnessing is a deliberate piece of financial engineering. Now, this sets up a much more interesting question. Why would they do this? Most of the time, when you see a reverse split, it's a move of desperation. It's a company trying to get its price back above $1 to avoid being delisted from the NASDAQ. That is the usual narrative. But if you read the company's press release from last week, they are very clear. This has nothing to do with NASDAQ listing requirements. The reality is far more strategic and frankly speaks volumes about what this company is trying to become. The company stated that the entire purpose of this split is to get the stock price above the $10 mark. Why? Because many large financial institutions, mutual funds and pension funds, the big players who manage Fidelity Wealth Management accounts or run Schwab Intelligent Portfolios, have rules in their charters that prevent them from buying stocks that trade over the counter or below a certain threshold, often $5 or $10. A stock trading at $1.67 is a penny stock, plain and simple. It's a speculative asset that a serious fund manager can't easily put into an intelligent portfolio. But a stock trading at $16.80, that looks and feels like a legitimate company. It opens up the stock to being held as collateral, to be used for margin, and to be purchased by a whole new class of institutional investors who were previously barred from touching it. This isn't a move of desperation, it's a move of perception. It's changing the suit the company wears to get into a more exclusive club. So, who is this company that's so desperate to get in the club? This is where the story gets even stranger. If you were looking at this ticker ETHZ about a year ago, you would have been looking at a company called 180 Life Sciences. It was a clinical stage biotech company. It was focused on therapeutics for chronic pain, inflammation, and fibrosis. And like many small-cap biotechs, it was burning through cash with no clear path to profitability. The stock performance was, to put it mildly, abysmal. It had lost over 99% of its value since it went public. It was a failure. The expectation was bankruptcy. The reality was a complete and total corporate transformation. The management, perhaps seeing the writing on the wall for their biotech pipeline, decided to completely change the entire business. They rebranded as Ethzilla Corporation and announced they were shifting their entire corporate strategy to become essentially an Ethereum treasury company. They are borrowing the exact playbook from MicroStrategy, which famously started using its corporate treasury to acquire massive amounts of Bitcoin. Ethzilla is doing the same, but for Ethereum, the world's second largest cryptocurrency. This pivot was supercharged by the news that billionaire Peter Thiel was a significant investor. Suddenly, this failing biotech wasn't a biotech at all. It was a venture-backed, NASDAQ-listed proxy for holding Ethereum. This isn't a company that uses blockchain, it's a company that holds a crypto asset. Its primary corporate function now is to acquire and hold ETH. The recent news confirms this. Just a few weeks ago, Ethzilla announced it had raised $350 million in convertible debentures. This is debt. They are borrowing hundreds of millions of dollars not to fund research or build a factory, but to buy more ETH. As of their last update, they held over 102,000 ETH. So, when you buy a share of ETHZ on your Fidelity trading platform or through Interactive Brokers, you are not buying a piece of a business that creates anything in the traditional sense. You are buying a small, leveraged slice of a massive pile of Ethereum, managed by a team that, until recently, was trying to develop pain medication. This makes analyzing the stock's recent movement incredibly different from looking at, say, Apple stock or Nvidia stock. When Nvidia stock moves, we look at GPU sales, data center growth, and AI chip demand. When Apple stock moves, we look at iPhone shipments and services revenue. When Ethzilla moves, we just need to look at one thing: the spot price of Ethereum. ETH has effectively turned itself into a closed-end fund for ETH, but one that trades on the NASDAQ and, crucially, can use leverage by issuing debt. The 1-for-10 reverse split today is the final piece of this transformation. They've acquired the asset, ETH, they've secured the funding, debt, and now they've changed the stock's price to make it look attractive to the institutional investment world. They are trying to bridge the gap between traditional finance and the crypto world. The expectation is that this provides a safe, regulated way for people to get exposure to Ethereum. If you have an individual brokerage account at a place like Fidelity or Schwab, and you're prohibited or nervous about buying crypto directly from an exchange or using Robinhood crypto, you can just buy ETHZ. It's a simple online investment in a stock. The reality is that this is an incredibly high-risk, leveraged bet. The company's balance sheet is a sight to behold. It has massive debt from the convertible notes, and its primary asset is one of the most volatile financial assets on the planet. If the price of Ethereum falls 50%, Ethzilla's equity could be completely wiped out by its debt obligations. This is not a safe way to buy ETH. It's arguably one of the riskiest. A self-investing individual would be far better off just buying ETH directly, where they have no leverage and no corporate overhead to worry about. But the existence of this stock isn't for the person who knows how to do that. It's for the person who wants investment help and wants to put it in their IRA along with their other stocks. The trading volume today is, as you'd expect, quite high, clocking in at over 5 million shares. But again, you have to filter this through the reverse reverse split. That 5 million shares is post-split. On a pre-split basis, that would be 50 million shares, which is significantly higher than its already high average. This tells me there is a ton of confusion. You have automated systems at Interactive Brokers and other prime brokerages adjusting their margin requirements. You have retail traders on the Robinhood app waking up, seeing the 900% gain, and either panic selling or, even worse, FOMO buying at the new $16.80, thinking it's going to $100. Then you have the arbitrage traders who knew about the split and are playing the volatility. And somewhere in the mix, you might have the first few institutional desks who were told by Ethzilla's management will be above 10 on Monday, finally starting to dip a toe in. It's a chaotic mess, and the price action reflects that. It opened, popped a bit, and is now just hovering as the market tries to figure out what the real value is. Let me ask you all watching this, comment below with your thoughts on this. Is this reverse split a brilliant strategic move to get institutional buy-in? Or is it just putting lipstick on a pig, a failing biotech that's now just a leveraged crypto fund? I'm genuinely curious to hear what you think.